Good evening, everyone. Time for another silver update. This is the 1 hour chart of silver provided by Netdania.com. You can click on the link below. And these charts have been graciously provided by Netdania.com. This is the free service, and I recommend that any of you who are interested in this data go ahead and visit their site. And for you high-end traders, this is some of the best data that's out there. We're going to get into the Netdania controversy, but first I really want to look at the technicals here. So this again is the 1 hour chart. I've drawn out what I am starting to see. I am going to be using some terms. I don't think they'll be familiar terms. Some of these terms and ideas are ones that I've come up with on my own. I don't know if anyone else uses them or not. I pretty much do my own self-taught technical analysis. So be that as it may, and whatever it's worth, that's what it is. So what I am observing here with these series of lines I've drawn, you can see I'm drawing these right angle 90-degree descriptions here on the chart. Now, I've described in videos before, based on Jesse Livermore's support resistance theory. I've described that theory a number of times. For those of you who haven't watched those videos, it's really a pretty simple concept. That Livermore's support resistance theory is that a price will trade within a range until it approaches the edge of the range, which usually is a flat line. So we would want to draw a flat line here, but I've somewhat modified the Livermore concept in that the bottom and the top of the range, I draw the bottom of the range as a trend line. Livermore would draw it as a flat line. So when Livermore was requested to give a tip as to where the price of something would go, he would reply saying, okay, I'll give you a great tip. If you see silver trade above 34.50, buy it. And if you see silver trade below 30.25, sell it. And of course that would engender the reaction of, well, you didn't tell me what to do. Well, no, I didn't tell you what to do. I told you what to do if something else happened. So that's the generic principle of support and resistance. And you can see it's fairly well proven by this situation here. Now, I wanted to introduce this principle. Actually, not introduce because I've covered it before, but the term I use for it is the reverse battering ram principle when you're talking about a rising bull market. And the concept is really pretty simple. If you're thinking about a battering ram situation where you can imagine this resistance line is the wall of a castle or something like that. You know, if you're trying to breach the castle, you're trying to break in. If you're using a battering ram, you're going to hit the wall and you're going to back out. And you're going to hit it again. You're going to have to back out farther. And you're going to have to back out until you have enough momentum to break through that wall. And then normally when you break through that point of resistance, you're going to travel significantly after that. Now, the way that markets trade is the opposite of that. What they do is they come up to the resistance point and then they fall back, but they don't fall back as far as they did the last time. So we had our first test about here, and we fell back to here. Then we fell back to here. Now, this is kind of a violation, but you can see we came up and hit here, just a little fallback, and right here we get where we're just kind of hovering right next to that line, and we finally get that little break, test back to the line, and boom, we break out. So that's the pattern we're seeing here. We have the same sort of right angle formation here, and you can see as soon as this morning, as we got above that right angle formation, we just blasted off. And I have to go in a little bit closer to show you that we're actually forming the same thing in a shorter time horizon on this one. But before I do that, I want to address a little bit of the Netdania issue that I'm going to talk about. Now, you can see here, obviously, when you look at the volume, I put the volume chart down here, or the volume graphs at the bottom, and you can see that you have this dramatic drop-off in volume roughly about the 19th of January. Now, for those of you who are real detectives and want to do your homework and investigate, you could probably line up these dates with some type of future contract rolling off. And we're going to talk a little bit about the cash and the futures contracts and how those interact. But obviously, just looking at this volume here with the dramatic drop off here and the rise there, we're obviously looking at a rolling over into futures contracts. So, and we're going to talk about this in a bit, but I just wanted to point that out while you're looking at this chart. So let's move into the 1 minute, and hopefully our lines are going to be preserved. So you can see now this right angle line that we had is preserved here as well, and we'll pull out just a little bit farther to look at that, and you can see we're still operating under this right angle battering ram type of thing. So if this pattern is to continue, which it very well could continue, we're going to start to butt up against this line, which is around 37.2, and then we're going to breach it, and we may breach it by $2 or $3. So if you remember yesterday, I pointed out, and I'm going to draw some lines on this chart to demonstrate what I'm talking about. Probably want to do the 8-hour instead. That this was a key point that I was talking about, the rapidity of the decline through this price range. And my concept was that if we don't really have a period of significant trading in the price range, the resistance is not as well established. So let's go back to our 36 line here, and I'm going to draw a little range so we can look at it, and we'll just get as close to 36 as we can. Just draw this straight across. And if you remember, the other range that I was talking about was roughly around the 39 price, and that's about where this drop off came. So we'll just eyeball it and say it's 39.09, but we'll just go with that range. So now that we have this range drawn, you can see the movement activity that we had through that price range. This movement was a straight line movement, so there really wasn't a lot of trading that went on during those two price ranges. We pretty much dropped straight down from 39 to 36 and went all the way to 26. So this isn't going to offer a lot of resistance. This price activity here is kind of a bottoming in this rising formation, and you can see there's a lot of spike downs there. The previous one is a blast through it. We have a little bit of activity here, but mainly a crash down through it and up and then down, and we have this one. So we really only have 1, 2, 3, and 4 instances of trading through this range. And my prediction or my guesstimate was that since we went through this range so rapidly on the downside, it was quite possible that we would penetrate up through this on the upside as well. So that seems to be what we're doing, and it would not surprise me at all if we had a continuation move that actually just kind of moved like that. Now, finally, I want to take you out to the weekly chart because we need to draw in the MACD on the weekly chart. The silver bears have pointed out since the May smackdown that the silver bull market is over, and I think we can safely now say that they couldn't be more wrong. The silver bull market is really just beginning, and I think this chart pretty much bears that out. You can see that we're just 3% or very small amount below on the red line of the zero cross. And the last zero cross we had was back here in the 2009 rally. That gave us a healthy rally, but not a significant rally as far as new highs. And you can see we started when we crossed through. And my projection for this one is that we would actually get a very strong breakthrough through this MACD. So we're actually on the weekly operating on a position of very high strength. We're just about to cross that zero line, and very often the crossing of the zero line, here's a cross above the zero line, but you can see what the price did from there. So it would not surprise me, I would not be shocked at all to see a move through 40 and 45 even in a few weeks' time. Now that seems shocking, but it wouldn't really shock me at all. That's the type of volatility that silver can do. So let's jump over to the main story, and that's going to be about Netdania. But first I want to show you the message board. There's a new forum on the message board, and it's about user questions, and so we just have one that is talking about this very issue that's coming up. So I want to read that real quick. The recent post by Silver Doctors in regards to the alleged 110 million ounce failed smackdown has caused a ton of controversy. Could you please explain how the price of futures and spot price are related or not related? The prevailing argument against the doc's post is that Netdania doesn't reflect futures prices, and so his argument that it was a 110 million ounce failed smackdown attempt is complete rubbish. Could you also address where there is any evidence of the turbulence other than on Netdania? There seems to be some debate revolving around this issue too. I ask all this because if the doc's thesis was born out of a failure to do due diligence, that transfers to you for covering it, and I really don't like that, because I'm a huge fan of what you're trying to do. For the sake of your own legitimacy, this issue needs to be addressed by you, since the doc has failed to do so properly. Well, I'm not going to make slams against someone else's channel, but that's his statement. Please either clarify things for him and us, or separate yourself from the issue. So kind of an ultimatum issued there. I don't know if I can live up to this, but I'm going to do the best I can on it. The first thing I want to take you to before we delve into this issue is the Netdania terms of use disclaimer, because this is really important in this issue before we look at the data. This is the disclaimer, and Netdania is for big traders. They've been very gracious to provide their free charts, and I think all of us should thank them for providing the free service that they do. They have no obligation to do so, and they provide excellent charts and excellent technical analysis, and that's why I always encourage people who are traders who can afford the service to sign up for that service. I have no advertising connection with them. I just use their charts, and I appreciate what they offer for free. So let's read their disclaimer and understand what they're saying here, because it's very informative. 6.3. In no event shall Netdania and or its respective partners be liable for any special, indirect, or consequential damages, or any damages whatsoever resulting from loss of use, data, or profits, whether in action of contract, negligence, or other tortious action arising out of or in connection with the use of performance of information available from this server. The documents and related graphics published on this server can include technical inaccuracies or typographical errors. Changes are periodically added to the information herein. Netdania and or its respective partners may make improvements and or changes in the products and the programs described here at any time. Copying or reproduction of the software in any other server location for further reproduction or distribution is expressly prohibited. Netdania, at our discretion, provides you with services including but not restricted to news or information services. You agree to comply with the conditions imposed on your use of the services, etc. Certain data accessible on our services is the intellectual property of the relevant news and information service providers or third parties that provide the data relevant to the service provider. So that's pretty clear to explain to you that they're getting their data from someone else. The data is protected by copyright and other intellectual laws. All ownership rights remain with the information service provider or third party, as the case may be. You may only use the data retrieved from our services for your own personal and non-commercial purposes while accessing our services. Such use will be in accordance with these terms, etc., etc. The data is provided as is. Any information service provider or any third party shall not be liable to you or any third party for any loss or damage, direct or indirect or consequential, arising from any inaccuracy or incompleteness in delays, interruptions, errors, omissions in the delivery of data or any other information supplied to you through our services, or any decision made or action taken by you or any third party in reliance upon the data. And it goes on. So I'm going to post this disclaimer so you can read that and understand that. Netdania is getting information from other providers, and I think when you look at the chart, so the first thing we want to do is we want to go to the tick chart and clear out all the information. Now, I did not have the opportunity to catch this, as I covered before, the candlestick information when it occurred live. And you can see, well, I still have my lines on, so let's turn those lines off and clear the chart. But we can't go back. If you see, we cannot go back to the tick data. My guess is if you could go back to the tick data, and this is the point that we still have on the chart where this interesting occurrence happened. Let's clear off all the indicators. And we're talking about this right here. Now, unfortunately, we covered it at the time, and if you remember, it was many red candlesticks in a row, and I pointed out that's a very anomalous behavior. Normally, a series of red candlesticks is going to be a decline. So that was the first thing to clue you into the fact that this may have been anomalous data. Now, if you followed the Da Vinci commentary on this, Da Vinci did not believe it was anomalous data. Da Vinci believed that it was actually a battle in the market between two different players, long and short, and the longs actually won. Now, if you look at the resultant price changes after this occurred, that would tend to indicate that Da Vinci could have been correct. So, but let's pull up the volume data to show you very clearly that we're talking about a series of price data information. You can see that spike there. This is the spike we're referring to. But you can also see these other series of spikes. Now, these are obviously going to be COMEX trading periods. These are going to be the main active periods in the silver contract. So, yes, this spike is anomalous as it was during the Globex trading, and I'm going to pull you out farther to the chart I was at earlier, which is the 8-hour, that will show you. Actually, want to pull out to the daily. It's going to be the 4-hour, I'm sorry. So when we go to the 4-hour, we get the clearest indication when we get our indicators taken off of here and just use the volume, that we have very distinct differences in these volumes. You can see a section here that goes for a very long time, and then we have this anomalous section here with very little volume. We have this section here with very high volume, another low anomalous section, and then this section with declining volume. So to understand these volumes, we need to look at the issue of cash versus futures markets. So I'm going to delve into that real quick here. You have a cash market and you have a futures market. And I'm just going to read this real quick and then comment. There are currently two separate yet related markets in which commodities are traded: the cash market and the futures market. The cash market refers to the buying and selling of physical commodities. In a cash market transaction, the price and exchange of product occurs in the present. In contrast, the futures market deals with the buying or selling of future obligations to make or take delivery rather than the actual commodity. A cash market transaction occurs in the present, but a futures market transaction is an agreement for an exchange of the underlying asset in the future. And it goes into cost to carry, and it goes into arbitrage. And this is very important. Arbitrage is the glue that holds the futures markets together. Without arbitrage, there would be no incentive for price in the futures market to correlate with prices in the cash market. Okay, so there's your key. As you approach the date of the futures market, you're going to have a tighter and tighter correlation in arbitrage, because the people who are dealing in the cash market are literally going to be days away from the futures delivery price, and those prices will tend to come closer and closer together. So when you're dealing with a reporting service like Netdania here, you have to deal with the rolling over of these contracts, and that's going to change the volume because you're rolling from month to month. I don't know offhand the active futures months for silver. I believe it's March, June, September, December, and an off February, something like that. So you've got these active delivery months. You've also got cash trading in that month. As you approach that delivery date, the cash is going to come closer and closer to the futures. So as Netdania, who, by the way, is reporting not just the rolling months for cash and futures, but they're also reporting off-hours trading. So let's look at that chart real quick here and examine that. You can see when we get to, let's actually go to the 1 minute chart to try to give us a better explanation here. You can see that the period of time right here, that's 4 p.m. Eastern time. It's very clear at 4 p.m. Eastern time, the trading, I believe that is the COMEX trading, ends. And that coincides with a significant drop-off in volume. That volume picks back up significantly at 1800 hours. That's the 8 p.m. Actually, that's the 6 p.m. open, which I believe, don't quote me on this, excuse me, I believe that corresponds with the Asian TOCOM opening. Perhaps that's the Globex. I don't know for sure, so you can investigate further. But it's very clear from these relative volumes that you can see reported on Netdania, and this spike that is controversial here, you can see that spike came in at the 15.0. So our corresponding time here today, 15.0, you can see not a lot of activity, but the volume falls off. So it's obvious from the chart, you can tell from the volume that Netdania is compiling various data sources and trying to report the most accurate information that they have, and that obviously fits in with their disclaimer. Netdania is only responsible for the, well, they're not responsible at all for the data, but they're only trying to report the data that they are given. They're not responsible for anomalies in the data, and they have no control over the anomalies in the data. And I think that we can safely say that this activity right here was an anomalous situation. They pretty much said that, but we can't know for sure. Now, I don't blame Netdania for this, but I blame the regulators and the traders and the CME and the COMEX and the markets, because obviously if these people were really interested in creating a 24-hour exchange for commodities and stocks, which we do have in currencies, they could very easily create that, but they're really not interested in creating that. They probably are much more interested in using their various time periods to do their manipulations. So that's the best I have on this story. I can't tell you all the answers, but I can tell you that this was an anomalous event, and it was followed by a tremendous blast off. We're continuing in the right angle pattern. If this right angle pattern continues and accelerates, then 39 could be a very, very close price, we could actually get there in a very short amount of time. We're just going to have to wait and see, and we'll talk to you next time.